Warren Buffett, often hailed as the father of modern-day investing, earned this title through a remarkable career. His journey began by transforming a struggling textile mill into a financial powerhouse, laying the foundation for what would evolve into the world's most successful holding company. Welcome back to my channel. Stay tuned to learn the strategic moves and secrets of how Warren Buffett built his $120 billion. Let's get started. His journey started with a childhood love for collecting things, a fascination with numbers, and a strong desire for independence. Like a talented athlete or musician, Buffett had a natural ability and a strong calling to make money exceptionally well. Born in Omaha, Nebraska in 1930, Buffett is the second of three children born to Howard and Layla Buffett. Buffett's father, Howard, was an investment broker and a four-term Republican congressman who moved the family to Washington, D.C. in 1943. Young Buffett was interested in business and investing at a young age. He began making money at the tender age of 6 by selling chewing gum door to door. At age 7, he found inspiration in a book titled 1,000 Ways to Make $1,000. As he grew older, he expanded to magazines and Coca-Cola, and in his teens, he took on delivering newspapers. Unlike many his age, Buffett wasn't a big spender. He saved money diligently, much like his collection of bottle caps. Remarkably, he filed his first tax return at just 14 and saved $2,000. Even while searching for lost tickets in racetrack bleachers, Buffett was learning the math behind calculating a horse's odds of winning. This mathematical skill later became valuable in evaluating stocks. One of his most profitable ventures was a refurbished pinball machine, and he wisely reinvested the earnings to acquire even more machines. Buffett's interest in the stock market and investing started during his school years. When he was 10, his father took him to visit the New York Stock Exchange. At just 11 years old, Buffett bought 3 shares of Citi Service Preferred for himself and 3 for his sister Doris. By completing college, Buffett had accumulated an impressive $9,800. His thrifty mindset led him to understand the importance of every penny saved, realizing that each spent penny meant one less to invest. Unlike valuing money for its immediate worth, Buffett looked at it in terms of its potential growth through years of compounding. His determination to find promising stocks was evident as he went the extra mile by personally traveling to the offices of Geico to speak directly with the company's financial vice president. After being rejected by Harvard Business School, Buffett enrolled at Columbia Business School upon learning that Benjamin Graham, a well-known investor, taught there. He earned a Master of Science in Economics from Columbia in 1951. After graduating, Buffett attended the New York Institute of Finance. During this time, Buffett learned that Graham was on the board of Geico Insurance. Determined to seize the opportunity, he took a train to Washington, D.C. On Saturday, persistently knocked on Geico's headquarters door until a janitor let him in, and eventually met Lorimer Davidson, Geico's vice president. The two discussed the insurance business for hours. Davidson would eventually become Buffett's lifelong friend and a lasting influence, and he would later recall that he found Buffett to be an extraordinary man after only 15 minutes. Buffett returned to Omaha and honed his communication skills as a stockbroker by taking a Dale Carnegie public speaking course. Armed with newfound confidence, he applied his knowledge by teaching an investment principles night class at the University of Nebraska-Omaha. In 1952, Buffett married Susan Thompson at Dundee Presbyterian Church. The following year, he accepted a job at Benjamin Graham's partnership. Graham profoundly influenced Buffett, who described him as the second most important man in my life after my father. Graham taught Buffett the concept of value investing, which involves finding undervalued companies and holding onto them for the long term. This approach to investing has served Buffett well over the years. In 1956, Buffett established his firm, Buffett Partnership Limited, with 7 limited partners, including his sister Doris. By 1962, the partnership's net worth had reached $7.2 million. 1969, Buffett dissolved the partnership and gained control of Berkshire Hathaway Incorporated, a textile business. Under his guidance, Berkshire Hathaway evolved into a conglomerate. When Buffett first bought shares in Berkshire Hathaway in 1962, the struggling textile firm faced low-cost competition that threatened to push it under. Entranced by the stock's low cost compared to its book value and net working capital, he purchased a controlling interest in 1965. Shares were trading around $8 when Buffett bought the stock, rising to almost $20 in the late 1960s when he became CEO. Today, Berkshire Hathaway Class A stock trades at more than $550,000. How did he do it? Buffett used the textile company's profits to buy other companies, including the life insurance firm National Indemnity. The valuable thing about life insurance companies, Buffett found, is the float, the capital available after premiums have been paid, but before claims are paid out. Buffett could use this float to invest further, buying securities and other businesses that could generate more money to invest in more firms and shares. Closing his original investment partnerships in 1969, Buffett shifted to using Berkshire Hathaway shares to acquire companies. He bought See's Candy in 1972, which generated more cash flow for investing. He'd also invested in American Express, Bank of America, Coca-Cola, and Apple, among many others, focusing on solid brands and businesses with a secure economic advantage. Buffett closed the last Berkshire Hathaway textile mill in 1985, growing the company steadily as a conglomerate. Today, Berkshire Hathaway owns over 65 companies outright, with a market cap of over $791 billion. Having grown his first $9,800 investment into an asset base worth $120 billion over 7 decades, Warren Buffett has caused a stir. Questions about how he invests constantly spring up. Some say his investment philosophy is heavily influenced by his mentor, Benjamin Graham, who wrote extensively about value investing. Others say he got his investment strategies from his father, Howard Buffett. So what investment strategies did Warren Buffett follow that enabled him to grow his net worth to that amount in such a short time? Number 1. Long-term investing. Warren Buffett, one of the world's most successful investors and the CEO of Berkshire Hathaway, has built his reputation on his investing strategy of buying strong businesses with long-term potential and holding them for the long term. This principle is evident in his letter to Berkshire Hathaway shareholders in 1996, where he said, "If you aren't willing to hold a stock for 10 years, don't even think about holding it for 10 minutes. When he makes a purchase, he intends to hold the securities indefinitely." Coca-Cola, American Express, and Costco met his criteria and have remained in Berkshire Hathaway's portfolio for many years. Number 2. Never follow the crowd. Buffett is known for deliberately avoiding companies when investors are being too optimistic. One of his more famous quotes is to be fearful when others are greedy and greedy when others are fearful, just as he mentioned in this video.
If you have a temperament that when others are fearful, you're going to get scared yourself.
Buffett's steadfast approach faced challenges when technology stocks gained popularity in the late 1990s. Despite the widespread enthusiasm, Buffett, who was a technophobe, chose to stay on the sidelines. This decision attracted criticism from Wall Street experts, who dismissed him as outdated. The turning point came with the burst of the dot-com bubble, resulting in the bankruptcy of many experts who had previously scorned Buffett. In contrast, Buffett's profits doubled, underscoring the wisdom of his conservative investment approach. Number 3. Companies with unique products. Furthermore, Buffett considers companies whose products and services can be easily substituted for riskier than companies with more unique offerings. For example, an oil company selling crude oil. The problem is there are many places to buy crude oil and other energy options available. But if this company has a special kind of better quality oil that many businesses want, that's good. This unique and better oil gives the company an advantage because it's unlike everyone else. This advantage helps the company make money consistently year after year. Similarly, Buffett has long been a major investor in Coca-Cola. While many colas and other soft drinks exist, only one Coke exists. Number 4. Companies with reliable return on equity. According to Buffett, companies that consistently deliver a good return on equity over many years are more attractive than those with only a short track record of solid returns. Buffett believes the longer a company has maintained a strong return on equity, the better. He suggests reviewing at least 5 to 10 years of its return on equity to assess a company's historical performance. This longer-term consistency in delivering strong returns is a key factor he considers when evaluating investment opportunities. Let's hear Buffett's opinion about the company's return on equity.
It's kind of interesting. The Japanese companies earn very low returns on equity, and they have a bunch of businesses that earn 4, 5, 6% on equity, and it's very hard to...
Number 5. Companies with a growing profit margin. Buffett seeks companies with a healthy profit margin, particularly those showing a growth trend in their profit margins. Like his return on equity approach, Buffett examines profit margins over several years to filter out short-term fluctuations. To remain in Buffett's consideration, a company's management must demonstrate the ability to increase profit margins year after year consistently. This signifies effective control over operating costs. Despite his reputation, Buffett himself openly admits that he does make mistakes. But how did the Oracle of Omaha deal with failure, saving his business from downfall? Let's look at that, and I'll be practical by using some of the stocks he considered a failure as a case study.
You're going to make mistakes in life. I mean, there's no question about it. You don't want to make them on the big decisions, you know, who you marry and some things like that. So there's no way I'm going to make a lot of business and investment decisions without making some mistakes.
In a 2010 interview with CNBC, Warren Buffett said the dumbest stock he ever bought was Berkshire Hathaway. Buffett explained that he first invested in Berkshire Hathaway in 1962 when it was a failing textile company. He thought he would profit when more mills closed, so he loaded up on the stock. Later, the firm tried to chisel Buffett out of more money. A spiteful Buffett bought control of the company, fired the manager, and tried to keep the textile business running for another 20 years. Buffett estimated that this vindictive move cost him $200 billion. In this instance, arrogance was the reason behind Buffett's failure. Also, he was emotion-driven when purchasing most stocks at this company. As such, he failed to notice obvious signs that the company was falling gradually. By the time he realized it, he could not sell the company. Buffett could have allowed his failure to define him. Instead, he gathered enough confidence and commitment to push the company beyond this failure and make it successful. Berkshire Hathaway owned 415 million shares of UK-based grocer Tesco at the end of 2012. The firm sold some stock in 2013 after he started to sour on the company's management, but he remained heavily invested. In 2014, the grocer overstated its profits by £250 million, and as a result, the shares slumped by 45%. In his 2014 letter to shareholders, Buffett said concerns about Tesco's management motivated his initial sale of stock, which resulted in a $43 million profit. Unfortunately, he didn't move quickly on the rest. Buffett wrote, "An attentive investor, I'm embarrassed to report, would have sold Tesco shares earlier. I made a big mistake with this investment by dawdling." He admitted the move cost the company a $444 million after-tax loss. The lesson from this piece of Warren Buffett's history is to make decisions promptly. Renowned for his wisdom, charm, and philanthropy, Buffett's exceptional investing skills have earned him respect globally. If you found this video insightful, please like and subscribe for more engaging content. See you at the next one.